Hello and welcome to Billion Eyes. In today's video, we're going to be talking about strategies for minimizing risk in your investments. One of the most effective ways to do this is through dollar cost averaging. Dollar cost averaging is a strategy where you invest a fixed amount of money at regular intervals, regardless of the current market conditions. This can help to mitigate the risk of investing a large sum of money at one time, especially when the market is at a high. One of the most inspiring examples of the success of dollar cost averaging as an investment strategy is that of Charles Schwab. Charles Schwab was an American stockbroker and the founder of the Charles Schwab Corporation, one of the largest brokerage firms in the world today. He was known for popularizing the concept of dollar cost averaging in the early 1950s and was a firm believer in the strategy. Schwab's story is a true testament to the power of dollar cost averaging as an investment strategy. He invested a fixed amount of money in the stock market regularly, regardless of the market conditions. This approach helped him to accumulate a significant amount of wealth over time. In fact, by the time of his death in 1989, Charles Schwab had amassed a fortune of over $600 million, making him one of the wealthiest men in the world at the time. It's incredible to think that Schwab started his journey with just a small amount of money, but by consistently investing in the stock market, he was able to grow his wealth over time, despite market fluctuations. His story is a reminder that by using the power of dollar cost averaging, anyone can potentially achieve financial success. It's also important to note that Schwab didn't just rely on dollar cost averaging alone, he also diversified his portfolio and invested in a variety of different stocks and sectors, which helped him to minimize risk and maximize returns. By following his example and implementing dollar cost averaging along with diversification, you can potentially achieve similar success in your own investment journey. In short, Charles Schwab's story is a shining example of the power of dollar cost averaging as an investment strategy. He was able to accumulate a significant amount of wealth over time by investing a fixed amount of money in the stock market regularly, regardless of the market conditions. His story is a reminder that with consistency, patience, and proper diversification, anyone can achieve financial success through the use of dollar cost averaging. Charles Schwab's story is a perfect illustration of how dollar cost averaging can make you rich over time. It's a strategy that can help minimize risk and increase overall returns over time, making it a valuable tool for any investor. By following a consistent strategy of dollar cost averaging, investors can benefit in a number of ways. One of the main benefits is that it helps to smooth out the ups and downs of the market. Instead of trying to time the market, investors are able to take advantage of both the highs and lows by consistently investing a fixed amount of money. This can help to minimize the risk of investing a large sum of money at the wrong time. Another benefit of dollar cost averaging is that it can help to increase your overall returns over time. By consistently investing a fixed amount of money, you are able to take advantage of the power of compound interest. This means that the money you invest today will earn interest, and that interest will also earn interest, and so on. Over time, this can add up to significant returns on your investment. The power of compounding works best when it is given time. By using dollar cost averaging, you're investing in a consistent manner and allowing the power of compounding to work for you over the long term. Dollar cost averaging is a powerful investment strategy that can help investors to minimize risk and maximize returns. One of the key benefits of dollar cost averaging is that it helps to smooth out the ups and downs of the market. Instead of trying to time the market and potentially missing out on the best opportunities, investors are able to take advantage of both the highs and lows by consistently investing a fixed amount of money. This can help to minimize the risk of investing a large sum of money at the wrong time, and can provide a more consistent and steady growth in your investment portfolio. Imagine a scenario where you invest a lump sum of money in the stock market, let's say $10,000. Now, imagine that the market goes down immediately after your investment. You would have lost a considerable amount of your investment. But, with dollar cost averaging, you would have invested that $10,000 over a period of time, say 6 months, thus spreading the risk and potentially buying shares at different prices, averaging out the purchase price. This can help to protect your investment from market fluctuations and provide a more consistent growth over time. Implementing dollar cost averaging into your investment strategy is relatively simple. The first step is to decide on a fixed amount of money that you will invest on a regular basis. This could be on a monthly, quarterly, or annual basis, depending on your preference. Once you have decided on the amount of money you will be investing, you need to decide where to invest it. This could be in a mutual fund, an ETF, or individual stocks. It is important to remember that dollar cost averaging should be used in combination with a diversified portfolio, in order to minimize risk. The next step is to set up a schedule for your investments. This could be done through an automatic investment plan, where a certain amount of money is automatically transferred from your bank account into your investment account on a regular basis. In conclusion, dollar cost averaging is an effective strategy for minimizing risk in your investments. By consistently investing a fixed amount of money, regardless of the current market conditions, you can help to smooth out the ups and downs of the market. This can help to increase your overall returns over time and minimize the risk of investing a large sum of money at the wrong time. Charles Schwab's story is a perfect example of how dollar cost averaging can make you rich over time. It's important to remember that no strategy is a guarantee of success, and it's always important to diversify your portfolio and conduct proper research before making any investment decisions. Additionally, it's important to keep in mind that dollar cost averaging is not a guarantee of success, and there are still risks associated with investing. However, by incorporating dollar cost averaging into your investment strategy, you can help to minimize those risks and potentially increase your overall returns over time. Thank you for watching, and be sure to subscribe to our channel for more videos on investment strategies and tips on how to billionize your wealth.